most of the investment professionals can't beat the index. As a retail investor, can I beat the index? Well, I think if you do a lot of due diligence, then you can beat any professional money manager. And there's a lot of pressures for money managers that we don't have as individual investors, which is why I think that individual investors like you and I can beat these money managers. And the pressures that these money managers have is that they have to generate a positive return if they're in a hedge fund most quarters and most years, otherwise they lose their jobs. Also, they have to chase performance, a lot of them, at the end of the fourth quarter, or they don't get a bonus and they might lose their job. And so it kind of forces them to do irrational things. In addition, these professional money managers, what they do, and this is a good thing, what they do is they run a very diversified investment portfolio consisting of stocks, for example, from many different sectors and many different countries as well. And so as they work towards creating a diversified portfolio, and they look at many, many different stocks, and they have many different pressures from senior management to outperform and to stay within certain limit measures like being a net beta long or net beta shorts. As they go through all these distractions, it's tough for them to outperform on every single stock or make money in every stock, of course. I think if you roll up your sleeves and use the methodologies that I teach in my MBA degree program, or if you take my complete financial analyst course on Udemy, I'm quite confident that if you do the work, there's a good chance you can beat these professional money managers. And I think that mutual funds are a scam. And if you want more details on this, go to my YouTube page and do a search on mutual funds scam. The bottom line is that mutual funds charge 3, 4, or 5% in fees every year and many hidden fees. Plus, they underperform ETFs, which is exchange traded funds, which have fees of 0.5%. So what this means is this, I'll show you. So an ETF is an exchange traded fund. And what that means is you can actually buy all the stocks on the biggest US stock market called the S&P 500, the biggest US exchange. So you type in SPY, and this is the ETF for what people call the spiders. That's what traders call it. But it represents 500 stocks in the S&P 500, which means 500 stocks that sort of make up what the US economy looks like. And so if we go here to profile on this S&P ETF, we could see here that the fees are actually very, very low. The fees are actually 0.09% per year. That's amazing. Versus a mutual fund that can have 3, 4, or 5%, including hidden fees. In addition, when you buy these ETFs, your taxes are lower if you make money. Hear me out on this, please. So the way it works is, in most countries, governments will reward you for being a patient investor, meaning if you hold an investment for more than a year and then you sell it, you pay less in taxes, versus if you held an investment for less than a year and then you realize profits by selling it, you pay more in taxes. And that's called capital gains taxes. And so governments usually reward you for being longer term focused. And so when it comes to buying ETFs, usually there's not much transacting going on by the company that built that ETF product, meaning a company like Schwab or Vanguard or S&P. As a result of them not turning over their book or buying and selling a lot, there's lower taxes for you when it comes year end and time for you to file taxes. When it comes to mutual funds, what happens quite often is a lot of portfolio managers are chasing performance, which really messes up their mindset when it comes to investing. They chase performance towards the end of the year and they buy and sell a lot of stuff because they want to make more money and they want to keep their job as well. As a result, the taxes that you would pay if you held a mutual fund that made you money would be much higher in most countries than if you held an ETF. And ETFs beat mutual funds anyway. 90% of mutual fund portfolio managers underperform indexes like the S&P.